Hello everyone. Today's subject will be manipulation and mitigation, and how these two concepts allow the market to move efficiently, and how larger players and market makers work together to fill their positions and to ensure that price is delivered efficiently. Now, these again are not ideas that I've come up with myself. These are some things that I've learned along the way. Okay, and there are a lot of people that will disagree, okay, and will tell you that the market isn't manipulated and that it is all random, which I'm not here to argue about, okay? This is how I view the market, and viewing the market this way fits perfectly in with my strategy and allows me to take higher probability setups. So if I'm able to spot manipulation as it occurs and react accordingly, then obviously the strategy using the broken base is going to be much more successful. So I'm going to run through these points that I have on the right, and then I'm going to go over the diagram that I have on the left. So some of you may not know this, but when you place a stop loss for your short order, you're actually placing a buy order. The same goes for placing a stop loss for your long order. So when you place your stop, you're actually placing a sell order. So let's say I am going long here. I buy at market inside this yellow box. When I place my stop loss below this low, I'm actually placing a sell order. So if price were to reach my stop loss, I'm actually selling my order back to the market. So entering positions at market or filling limit orders for the majority of retail traders or even larger traders is not an issue. Okay, so you can fill 1, 10, 100 lots quite easily on pretty much all brokers. Okay, but for larger players, they have to follow a slightly different approach if they wish to buy or sell at a desired price. Now, it may not be the institution itself that is actually executing these orders. It may be the market maker that has to effectively or efficiently move price around so they can efficiently fill the order for their clients. But regardless of that, we're just looking at how price moves here. So for the larger players, the institutions to fill their orders, if they have larger orders, they have to follow a slightly different approach. So if the larger player were to try and buy their entire position at one, price will quickly move toward higher prices before their entire position has been filled. So because they are trading with such large amounts and other institutions may be trying to fill orders around the same price, what we often see, or what you would see, is price moving away from the level that they want to purchase their order at. Okay, so if they were to buy at one before their entire position is filled because they're playing with so much volume, price is moving away, and there is no longer enough liquidity for them to fill their orders. So remember, if someone is buying, there has to be another player on the other side of the market selling to the buyer. Now this is very important. So obviously, if you or I wanted to get our positions filled at one, we obviously don't want to scale it at 2, 3, 4, and 5. We want all of our positions filled at one, and the larger players, institutions, want to do the exact same thing. So they have to follow a slightly different approach in order to have a cost-effective way to enter and manage their positions. So what is this approach, right? Larger players, for the most part, want the exact same thing as the smaller players. They want to fill their positions at the most desirable price. So how do they accomplish this? By manipulating the market and generating liquidity to help fill their orders and ensure they're able to maintain the desired overall market direction. So they generate liquidity in the market by printing clearly manipulative moves. Now, if you haven't been through the PDF, you haven't read through all of the notes that I've put in there about manipulation, then make sure you go and do so. But essentially, a manipulative move is, for example, down here we have 2 equal lows. Price moving below those 2 equal lows would be a manipulative move. Now, your goal is not to just try to see if you can pick a manipulative move below the lows, okay? The goal is to wait for the broken base to form to confirm that this was in fact a manipulative move. So essentially what I'm trying to say is that the larger majority will be tricked into taking the other side of their trade so there is enough liquidity in the market for their orders to be filled. So as you see price returning or moving below these equal lows, there are players either trying to long at resistance. So if they were trying to buy at the double bottom, they would have their stop loss below the double bottom. Okay, and remember their stop loss being a sell order. Now, and the same goes for SR traders. So if price moved below this double bottom, and they're looking at this to be a support resistance flip, support turning into resistance, they would short on the break at the double bottom with their stop right below, with their stop right above, sorry. Okay, so now you have two kinds of traders, the SR traders and the support traders, all providing their sell side liquidity to the larger players who are trying to fill their buy orders. And now that there is more liquidity in the opposite side of the trade, they are now able to fill their orders efficiently. Okay, now again, I'm not trying to tell you to predict that this move is manipulative. I'm simply trying to teach you to look for the confirmation after manipulation, right? So their orders are filled here. Now price can move up, okay? But before price reaches below this double bottom, how do we get below here? So they print the double bottom, okay, putting fake walls of buy orders here to act as support to ensure that price doesn't fall too far down. Now they need to push price below these lows. So inside this manipulative leg, before we reach below the lows, they're selling. They're selling so they can buy back here. Now that price has shot up, they still have their short orders that were placed in here that they used to send below the lows. So although they filled their long positions, they're now underwater on shorts, which is not a cost-effective way to trade. You do not want to be underwater. Okay, so then right here, they push price back down into the area where they were selling, where they then let go of the short orders used to press price below the low. Now they can let go of their positions and send price up. Now they are long from here, they are long from here, and they no longer are holding the underwater short positions that were used to push price below the lows. Now, this is essentially what we see in every single price leg, regardless if there is a broken base or not. Price is moving, and it needs to move efficiently. For price to reach a destination, someone needs to be buying or selling. Now, if the goal of that person buying or selling is not to actually hold on to their position, but rather create an efficient market, they're going to want to mitigate those orders. Okay, so let's continue through here. They filled their orders, they've mitigated the shorts, they sent price back up, and now we're looking for a double confirmation. So essentially all the double confirmation is confirming that this was in fact manipulation. Okay, that these orders were in fact mitigated and price has been sent up because the larger players are long. Okay, so we see the exact same setup, like a fractal form inside of the first broken base, and essentially this confirms the first move, and that is why we always wait for the second. So rather than trying to pick a reversal or pick the low of a retracement, you're going to wait for the second confirmation. So let's go through this over here. So double tops are a perfect example of how the smaller players are tricked into believing that price will stop at resistance. However, what we often see is a temporary move above the double top where price will then distribute and fall, okay, or below the double bottom. It is important to note that the same technique used to manipulate the masses at the top of swings, at the top of swing highs and bottom of swing lows is also used to push price in a desired direction. Okay, so they are long from here, they're long from here, and they're long from here. So if we have a double top and a key swing right here, do you think that the traders that were trying to short the breakout of this double top, wouldn't they be trying to long the breakout of this double top? And then their buy orders, what will that do? Okay, that will help price move up, and that will help the larger traders move their positions into profit. So although these levels aren't providing liquidity for a reversal or the bottom of a leg, they will provide liquidity to help move price in the intended direction. Now, whether this is all true or not, this is a framework of how you can look at the market, and this will help you pick out higher probability moves if you can pick up on these patterns and pick up on when price is in fact being manipulated. And you can start to move, you can start to be on the other side, being the right side of the market, rather than the person trying to short this double bottom. So like I explained, for price to move up, someone needs to be buying. For price to move down, someone needs to be selling. The same concept applies to the manipulative moves. Using a double top as an example, for price to run above the double top and start to distribute around here, someone needs to be buying. The same person or entity that wants to fill their short orders above the double top also needs to buy in order to push price above the double top. So the same person who wants to sell here is looking to buy here to ensure that there's enough liquidity for them to fill their short orders. Okay? So if the bigger player is buying just so they can sell later on, right here, how do they manage their buy positions once price starts to fall? They mitigate their positions. And this concept is the very framework for this entire strategy. Manipulation, okay, being the move above the highs, sponsorship being the confirmation of the broken base, and then mitigation being the return to the rate base or the rate candle, and that is our entry. So this is why the rate candle is such a powerful area of price action. Once price returns to the rate candle, orders will start to be let go and price will begin moving in the intended direction that the bigger player wants it to go. Now, the bigger player will not be one entity, okay, or one person watching your $100 stop. That's not what I'm trying to say. This is just a framework. Price needs to move efficiently. Orders need to be mitigated efficiently, okay, and this is exactly how it's done from a price action perspective, okay? This is what it looks like on the chart. So if you want to trade this strategy effectively, get to know this concept and accept that the market does move this way regardless of who is moving it and why. On to the next subject.